We're going to have a debate about a topic that gets everyone quite passionate, depending on which side of the fence you sit on. And to make it a little bit more interesting, Emma and I are married. And I've got to say, in 10 years of marriage, I'm yet to win an argument. So I don't rate my chances today. But with that, I'll let Emma start. And as a format, I thought we'd both set out our cases, our stall, passive investment management versus active funds management. And then we might throw it to the floor and take all the questions you guys have. So on that, I'll hand over to the lovely Emma.
It's buttering me up already. I can tell. Thank you so much for having us today. As Miles said, I am Emma Davidson. This is Miles Staude. I am the CEO, and he is the CIO of a firm in London called Staude Capital. And Staude Capital is seconded into the Australian-listed Global Value Fund, GVF for short. Global Value Fund has been listed for 10 years in July. We're very excited about that. We have annualized at more than 10% per annum over the last decade. And probably most impressive, over those 10 years, we have had positive performance in every single one of the years. So we haven't had a single down year, which we're very proud of. But we are not here to shamelessly promote GVF, obviously not. We are here to debate. And the debate, my dear husband, is active versus passive. Now, I'm going to be putting forward the case for passive, and Miles here is going to be putting forward the case for active investing. And as Miles said, after 10 years of marriage, we feel as though the best way to go is for me to set up my stall, then he will set out his stall, and then we will get questions from the audience to see who is right. Me. So before I get going, I also just want to be totally honest with you, the audience, and just let you in on a little bit of the baggage that we are bringing to the stage. I'm going to do a quick history. So Miles and I first met in London in 2009. We were both about a decade into our careers at that point. At the time, I was working for a large US investment firm, Miles selling the passive dream. Miles was working for a hedge fund, selling the active dream. Despite these differences, despite these different opinions, it was the noughties, and people were still allowed to have different opinions. So we started dating. And every day in London, I would go off on my merry way selling the passive dream, and Miles would go off to the hedge fund and write math formulas with his dorky colleagues. Now, back then, I would rely quite heavily on the SPIVA report. Now, the SPIVA report is the S&P indices versus active managers. Now, this is a scorecard. The inaugural scorecard came out in about 2002, and the whole point of SPIVA was to illustrate to people that it was so much better to go into passive because no active managers could really outperform their indices. Now, originally it focused in on the US and the S&P 500, but since then it was extended out to cover most geographical areas around the globe. And just to say, you know, when I was looking at this report from 2004 to about 2014, it was pretty comprehensive. You know, there's a huge amount of resources put into looking at all of the managers that try to outperform the S&P. And the reporting would take care of things like survivorship bias. It would look at multiple shares. It was really well curated data, if you like. And I remember when these reports got to us at the investment banks in London, you know, we were completely over the moon because this huge amount of data would be presented to us on a plate of why passive investing just made sense and why paying an active fund manager to outperform an index just did not make sense, right? And when the reports, when they did go into the detail, the report would kind of point to to those three things there, those four things on the slides. First, it would talk about the fact that active fund managers are just charging the fees are impossible to overcome in terms of trying to outperform the index. Then they would talk about an active fund manager is turning over his portfolio all the time, his or her portfolio all the time. And that, of course, is causing a lot of costs. There was also survivorship bias. So a lot of active fund managers just don't survive. They just don't make it. And then there was performance consistency. The ability to perform over and over, year in and year out, was just not there. And this is what the scorecards pointed to. Now, as I said, I was using these scorecards from about 2004 to 2014, and they were reliably damning back then. You can therefore imagine that when we were asked to do this debate, the first place I headed to was the SPIVA reports. You know, what do they look like now, 10 years later? Is the data still as convincing as it once was? Is it still as well presented? Is it still as well resourced and comprehensive? And sadly for you, my dear husband, what I was presented with was even bigger reports, even more data, more areas covered, and longer time periods. What was clear was that very little has changed, except now we have 20 years of data, which would seem to suggest that things have gone from bad to worse for active fund managers. Now, rather than me rabbit on, I will keep my case short and sweet, and I will show you three graphs. Oh, actually, before I do, let me explain what I'm going to show. Three visuals from US, Europe, and Australia. And yes, I am unashamedly using S&P's data because it is very comprehensive. The charts I'm going to show you are showing you, in the US, for example, they are showing you all the active fund managers versus who are benchmarked to the S&P 500 versus how the S&P 500 has done. So the S&P 500, top 500 companies in the United States, and it's showing how many have outperformed the index. Twelve percent. It's not good. Over 15 years. 12% of active fund managers were able to do better than the S&P 500. Maybe Europe's better. Let's look at Europe. Now, Europe, we're looking at the S&P 350, top 350 companies in Europe. Hopefully that's better. Worse. Less than 8% of active fund managers in Europe have managed to outperform the S&P 350. Australia, come on, Australia. Oh, pretty dismal. Less than 15%. And I shall rest my case there, Your Honour. Over to you, Miles.
Very good, very good. 10 years of marriage, a lot of data pushing uphill. I certainly feel like, and looking at the data and Emma's very persuasive points, it looks like I've got the harder case to make tonight. And certainly if you've read the press or followed any of the commentary about active fund management versus passive fund management for the last few years, I should be in the hot seat today. I'm not. I feel very passionately I'm not. But before I get into that, before I get into my points about why a lot of what we see about passive investing today is over-exaggerated, I want to say one thing clearly for the record. In my view, passive investing has been wonderful for finance. It's been a wonderful innovation. It disrupted the funds management industry. It drove down costs. It's held active managers like our firm to account. And it has definitely improved investment outcomes for all investors, but particularly for retail investors. So that's absolutely something we should celebrate, and I fully celebrate that. With that said, in my view, the original innovation of passive investing is quite dated now, and the finance industry has really moved on since then. Worse, again, my opinion, so I don't get sued, a lot of the hype that we see from the passive investment industry these days is over-exaggerated. The things that it promises to do, I don't think it can do. The case that I want to make today is that passive investing There we go. Passive investing was a great innovation. Today, however, its benefits are often exaggerated. I'm going to argue that the world has really moved on since the original innovation of passive investing, and given that, I want to debunk some of the marketing spin that I see bandied around. I'm going to argue that active can outperform passive, the crux of our debate today, if it's in the right setting. However, I am certainly going to concede that there's still some active managers out there that charge far too much for pretty pedestrian results. And finally, I'm going to suggest that these days, if it's done well, passive and active should be trying to do two very different things, and those things can complement each other quite well if used sensibly. To start off with, though, I'd like to expand on your definition of what passive investing is and how it works, and why it was originally such a great innovation. I agree with you that passive investing means an investment strategy that tracks a financial index, but I think it's really important to understand why that's what passive investing does. There's a concept in finance called the efficient market hypothesis, and what it says in a nutshell is that all the publicly available information is already in the price before you or I turn up and try and decide whether we're going to buy and sell shares. Historically, the way financial markets have worked is that there are teams of hard-working analysts, I used to be one of those, examining company accounts, studying industry trends, and there's a small army of super bright economists crunching data, building models, and all those people and all that work goes into working out the right price for financial assets, whether it's the value of a company's shares on the ASX or the value of the Australian dollar in the international markets. And that work, that analysis, forms the bedrock of our free market system. We let the data and free market principles decide where we allocate capital to. If a new company comes along with a clever new idea, investors who agree, investors who have done all the hard valuation work, will give that company the capital it needs to make that clever new idea a reality. What the efficient market theory says is that given there are so many people out there analysing all the information that's available, investors, all the information that is available, everything you could want to know about the company is already in the share price before you turn up to buy. Now, passive investing takes the idea of the efficient market theory one step further. It says if all the information is already in the price, why bother doing any of that analysis? Why bother incurring any of those costs? Let's just piggyback off everyone else's work for free. It's quite a clever idea, really. The final part of passive investing is portfolio construction. The original idea of passive investing, the one that has the most robust academic underpinning, is that you want to create a portfolio that replicates the market return as a whole, because the market return is the best return you can actually realistically expect to achieve over time. Now, what the market return is a bit of a wonky academic concept, but basically it means you weight your investments by the current market values, as that provides you with a broad-based slice of the economy as a whole. So here in Australia, if BHP was the biggest company on the ASX, maybe it makes up 10% of the index, you put 10% of your investment into BHP. If Commonwealth Bank is the next biggest investment on the ASX, makes up 9% of the index, you put 9% of your investment into Commonwealth Bank, and so on. So in summary, just to quickly wrap it all up, a passive investor does two things. Firstly, they don't bother analysing stocks, they just accept that someone else has done that work for them. And secondly, they don't bother trying to pick stocks. Instead, they just create a portfolio that matches a share market index.
I'm good with that.
Now, 20 years ago, when you started selling this stuff in London, the idea of passive was brilliant. It was an almost foolproof way of ensuring that you outperformed most professional money managers over time. Given that the active managers are the ones that are paying all the costs, bearing all the costs for making markets efficient, if you can match an index and avoid those costs, you're certainly going to outperform them given time. But the thing to remember is the finance industry is always innovating. The idea of passive investing was great when it was new. I'm going to argue that it's been overtaken by two very powerful trends over the last 20 years that are much more relevant. Firstly, by far, the most important theme in finance over the last 20 years has been the incredible growth of private equity capital and the disappearance of public companies from listed stock exchanges. Secondly, like anything that's successful in finance, passive has been turned into a big, profitable industry, and that business today pushes a lot of product that looks nothing like the original academic ideas that underpin how passive investing is supposed to work. Starting with private equity, a generation ago, when I started in the market, public markets were the only place that you could go to raise the large amounts of capital you need to fund businesses. A listing on a public stock exchange like the ASX or the New York Stock Exchange gave you access to the largest and most sophisticated pools of capital you could find to fund your business. No longer the case. Today, public market capital has largely been replaced by the private equity industry. As you can see on this chart on the right, 20 years ago, there were 8,000 companies listed on the New York Stock Exchange. Today, that number's nearly halved. Over the same time, the number of firms owned by private equity companies has gone from 2,000 to over 11,000, more than a five-fold increase. And the reasons for this shift are not hard to understand. Regulation, litigation, relentless public scrutiny, and of course the fact that any innovation you bring to market will be copied by passive investors. All of that means that taking money from the public markets these days is a lot less exciting, a lot less attractive than taking it from the public markets. Private markets, sorry. Today there are absolutely vast pools of private equity capital willing to take any exciting, any interesting public company private. There's literally trillions and trillions of dollars on the sidelines waiting to snaffle the best that the public markets can bring. And worse, new public companies, companies that got that clever new idea, don't come to the stock market to raise their growth capital anymore. That used to be the traditional life cycle of a company. You have an interesting idea, you raise your initial growth capital in the ASX. If it works, you grow from there, and that starts a life cycle for the company in the public arena. Today, if you're a company with an entrepreneur or a company with a clever new idea, you get your funding from a venture capital fund. If your idea works, you sell your company to a private equity firm. If it continues to work, they'll sell it to other private equity firms. And the private equity industry as a whole will extract everything that's exciting, all of the growth out of that company over its life. And really, the only time that company will end up on the public exchange is when the private equity industry doesn't want it anymore. And certainly there's a lot of really good companies that will never make it into the public arena these days. You can see on the right-hand chart here, less than 15% of all companies of any real size in the US are listed on the stock market these days. And that brings me on to my second point. As public markets are getting less and less relevant, the indices that track them don't look like the highly diversified baskets of companies that they used to do. The original idea of that market return, a balanced slice of the economy as a whole. You can see clearly now the vast majority of the economy sits in the private hands. And the parts of the economy that still do sit in the public hands are no longer the nicely diversified baskets they used to be. The best example is the S&P today. The S&P, probably the most tracked financial index in the world. 7 mega-cap tech stocks make up nearly a third of that index. Now, there isn't a financial advisor worth his salt that would say putting a third of your capital into a basket of high-risk, high-return companies is appropriate for all people all of the time. So the problem the passive investing industry is facing, my love, is that the public market indices these days are getting a lot less relevant. And in response to this, in my view, again, my view, my opinion, no one wants to get sued, the passive industry has started pushing a lot of new products that look nothing like the original academic ideas that underpinned passive investing. And to understand why, I want to let you in on a little secret, one that doesn't get anywhere near the airtime I think it should. And that is, passive investing is wildly profitable for the people selling it. As a business, you can run billions of dollars with just a few computers and a few data scientists. So while the fees are low, that is true, the economies of scale are absolutely enormous. This is an incredibly, wonderfully profitable business to be in if you're selling it. So this drive for profits, in my view, and the declining relevance of public market indices has led to a whole host of new products coming out that dangle in front of you the prospect of outperforming the market by encouraging you to pick sectors, themes, or jump onto trends. Tech stocks have been really exciting, really strong recently. Why not invest into that through a tech stock ETF?
I have noticed that. I don't know if you guys feel the same, but I've noticed that for me, when I think of passive investing, I think about the S&P 500, but then I've been to a few presentations recently where I've been pitched thematic ETFs, and I'm like, what? Isn't that
Hasn't that come full circle? And that's really the point. The problem with all these new products is the exact same research that says it's impossible to outperform the market by picking stocks also says it's impossible to outperform the market by picking sectors, themes, or following fads. Indeed, the research is very clear. The worst thing that retail investors can do is be encouraged into over-trading with their investments, buying and selling on the latest fad or the latest trend.
What does that pie chart look like for Australia?
I don't have the data for Australia. Australia is a very small capital market, but thematically it's certainly the same. The number of stocks listed in Australia has shrunk over the last 20 years. It has not grown. Oops, that's the punchline. I'll hang on to that. The second point I wanted to make today is that active investing can outperform passive. Yes, I'm going to say it, and I'm going to say it while I'm getting recorded on camera. As I said, 20 years ago, passive was a really exciting idea. However, under the rules of that game, active had no chance of outperforming. Active, if you remember, are bearing all of the costs in making capital allocation work around the economy. Passive are turning up, piggybacking off all those costs and getting a free ride. And since its arrival, the passive industry has been very successful in defining the rules of the game in a way that suits its marketing. The data that Emma put up earlier is a perfect case in point. The case against active is almost always made as this one-dimensional argument that the average active fund manager underperforms the market given enough time. And for a while, they certainly had a point. There were a lot of active fund managers that charged far too much for pretty pedestrian outcomes. And even today, that still exists in some parts of the market, but I would say it's a much less of a problem than it used to be. So to say, it is an absolutely true thing, as Emma said, to say that the average active fund manager underperforms the market index over time. That's the narrative we get told about all the time. However, another absolutely true thing to say would be that some active managers outperform the market, while all passive managers underperform the market. By definition, 100% of passive managers underperform the market indices they track. While their costs are low, they are not free, and the management costs are not the only costs that go into managing a fund. If you wanted to spin the marketing ball the other way, you could say that with an active manager, you at least have a chance of outperforming the market. With a passive manager, you're guaranteeing that you're going to underperform from day one. The more important point, though, is the one that I made earlier. Most of what used to be exciting about public markets happens in the private space now. Most active fund management happens today in private. And private equity investors, I'll hit the punchline now, have by and large reaped the rewards. You can see on this chart the performance of the private equity industry compared to public share markets over the last 20 years. And you can see over that time, private equity has outperformed by an annualised average of 6 to 7%, a staggering, consistent level of outperformance. The only exception to that has been the last 12 months when those mega-cap tech stocks in the US have dragged public markets higher and have given public market investors, for a very brief moment, a day in the sun. But over the very long term, it is 100% true to say that private equity has completely obliterated what's left of the public market to invest into. And of course, the really sad point about this seismic shift in capital markets is that retail investors are largely excluded from investing into these sorts of asset classes. The final point I wanted to make today, hopefully, is one of a conciliatory nature. And that these days, successful passive and active funds management should be trying to do two very different things. Both approaches have strengths and weaknesses. And instead of an argument that we often see over which is better, it really should be thought of as two different tools trying to do two different jobs. The analogy that I think is most appropriate is that how a lot of us might approach shopping. You know, Emma and I have recently immigrated to Australia, for me immigrating back to Australia. We've recently got 3 young kids, and the thing that I've discovered...
Recently got them.
recently picked them up. The thing that I think that I've discovered as being a dad that's given me an enormous amount of joy is Kmart. The kids love it. I love it. Emma's less of a fan. It's cheap. It's cheerful. It gets the job done. And whenever I need to buy something that I don't care if the kid's wrecked, Kmart is the perfect solution. But if I've got to buy something where the implications of getting it wrong are far too important to ignore, I go to Myer or I go to an independent boutique that I trust. I certainly don't go and buy the brake pads for the car at Kmart, no matter how cheap they're telling me they are. And I think that's the best way to think about passive investing these days. If you're young and you don't have a lot of capital to invest, passive makes an enormous amount of sense. It's a very low-cost way to own a piece of the economy. When you're young, you also have time on your side. You can cope with big swings in asset prices and compound that back in your favour. As you get older and you have less time on your side, or if you have a larger amount of wealth or a very specific financial outcome you have to plan around, I think using an active manager makes a lot more sense, particularly if it's done sensibly and thoughtfully in conjunction with the passive management industry. Now that's my case. I know I've made some contentious points, but I'll wrap it up there.
And that, ladies and gentlemen, is how a single woman living in London, not wanting any children, ends up in Australia with 3 children shopping at Kmart. Okay. I have one question before we go out to the audience. So, the S&P 500, I totally get your point on the Magnificent Seven, but I would come back and counter with, fine, we'll just equally weight the index. What do you say to that?
Well, I guess the point I'd make, and this I think is really the crux of how passive and active can work well together. What are you trying to achieve? So you're not trying to achieve the market return anymore. So again, this is one of the things that passive is very good at, wheeling out a new product. There's endless new products coming out all the time. If you're worried about the concentration risk, let's just equally weight the index. How does that match your investment goals or needs? How is that appropriate to you as an investor? The answer to that question is an active fund management answer. In fairness, there are all these great tools that passive put out today, and if they're used wisely by a financial advisor or somebody that is thoughtful about the investment outcomes you're trying to achieve and the risk that you're trying to run with, then that's a perfectly sensible thing to do. But everything I just said there is the art of active management. Like, we run a fund and we're very specific about how we manage risk and an outcome that we're trying to generate for our investors. It's got nothing to do with the financial index. I've got no interest in matching what the S&P is going to do or the Magnificent Seven is going to do. But it comes back to, if you're not going to try and match the market return, you're not doing what the academic studies say. You're basically randomly picking stocks. And is that going to match what you want to do?
I feel like I need help from the audience. Does anyone have any?
You have been, sir, in the stripy shirt, you've been asking the best questions all day, so I was hoping you'd sit in on this session.
It's got no microphone.
Thanks very much. If it's not too personal, and given your stage in life compared to what you just said, I would expect that personally you're very into private equity. I'm just interested what percentage of your personal portfolio, rather than those that you're managing, you've got in private equity.
That is a tremendous question. So I guess Emma and I run a managed fund, and most of our, outside of trying to get on the Sydney property market, most of what little wealth we have left, it goes into the personal fund. But in that fund, we make a lot of investments into private equity. We run a very specific strategy where we look for ways to invest into things at an exciting discount. So we own all those private equity kind of themes at the moment at sort of 70, 60 cents on the dollar. But to flip that on its head too, if you want to invest into these private equity funds today, it's very normal for there to be a minimum of $2 to $5 million to invest, which is well beyond our means and well beyond the means of lots of kind of mum and dad investors.
So we invest via our fund, is what he's saying.
We invest via our fund.
It's a very diversified underlying.
Thank you, Emma. Miles?